We found that a lot of the products in the market right now were pretty rigid. They were either expensive, they had high carrying costs, they had high fees on the front end, which made acquisition very difficult for anybody who was looking to purchase upwards. And a lot of the investors right now are like, get your single family home, you're looking to get a duplex to triplex, triplex to fourplex, and you're always trying to stretch that qualification to move up. And we found that the acquisition cost was just a lot. So being able to create a product that gave people the flexibility to be able to, take acquisition and then transition into conventional financing was really important to us. So we wanted to make sure that this product was going to be completely open. So this product is a 6-month completely open term, so there's no cost to break. As soon as you're done the project or you've stabilized and repositioned the building, you can refinance into a conventional lender without cost, which it saves a ton of money on the back end. When we underwrite this product, the main and most important aspect of it is
What's going on YouTube? It's Rebecca Lynn Matheson, and today we're joined by Josh and Ehren from the Findlay Mortgage Team. Guys, welcome to the channel today. It's great to have you.
Yeah, thanks so much for having us on. It's great to be back shooting content. It's been a little while, but we're excited to be back and explain and share this product that we've actually had the pleasure of creating for everybody.
Absolutely, yeah. So let's break it down a little bit. So MRP, what does that stand for? And then let's break down kind of the different dynamics of the product and what all you can do with it.
Yeah, so MRP stands for a multifamily repositioning product. Just kind of what we call it, gave it a little abbreviation there. But really I think where we want to start is just taking a look at some of the challenges that we're seeing from investors in the market and why we came about reaching out to our lender and trying to put this product together, and why we've been looking for other products as well too. So in the last 6 months to year and a half, really is a pretty wide timeline there, but we've seen a lot of investors go from the 1 to 4 unit space and have realized, when you're buying a triplex or a fourplex for 1.3 million, $1 million to 1.3, for a few $100,000 more, you're able to go and find a really good deal with a multifamily. So we've seen a lot of investors shift from that 1 to 4 space to this like 5 to 10 space, and it's really been filled up pretty quickly. Over the last year and a half, we started to see the prices on the multifamily side not only just rise with the market, but we're finding that sellers are now starting to price in the fact that you can purchase this building for undervalue and it has the ability to be turned over. So not only are you getting the market premium, you're also getting a little bit of premium just from the seller because they know what they're offering the investors. So we're seeing a lot of these buildings going for a fair bit over where they really probably should be selling for on the market. And that creates a challenge on the financing because if anyone knows anything about multifamily, and if you're new to it, multifamily valuations are all based off of the net operating income and its ability to debt service the mortgage. So when you're getting these high premiums on the prices and these really low rents that haven't been changed in 5, 10, 15 years in some cases, conventional financing is hardly an option at this point right now unless you have a large capital injection to bring to the deal. So with a lot of the deals being closed on the private market, we've reached out to some of our lenders to try to find some products to help reposition, take that product or the multifamily building from a private, turn over the tenants, do some renovations, and get it back into conventional financing.
Got it. So this is really a transition type product where you're able to really fully gain the full value of your asset that you have. So I'd love to hear a little bit more about the interworkings of this and how an investor might go about using a product like this.
Sure, yeah. So we essentially created this product for everything that Ehren said. It's just the challenges that are in the market at the moment, and some of the challenges that that we found when we were first introducing our clients into allowing them to reposition the building. We found that a lot of the products in the market right now were pretty rigid. They were either expensive, they had high carrying costs, they had high fees on the front end, which made acquisition very difficult for anybody who was looking to purchase upwards. And a lot of the investors right now are like, get your single family home, you're looking to get a duplex to triplex, triplex to fourplex, and you're always trying to stretch that qualification to move up. And we found that the acquisition cost was just a lot. So being able to create a product that gave people the flexibility to be able to, take acquisition and then transition into conventional financing was really important to us. So but this product specifically highlights a handful of things. So one being flexibility. So the flexibility for most private terms in the market, are usually 1 year closed terms, and those closed terms usually come with a 3-month interest penalty to break. Now, because your payment is an interest-only payment, that means if you break your term, you break any time within the term of your loan, you have 3 months of payments. And if you're talking about $1 million loan amount on 8% or 9%, it's a significant monthly payment you have to pay up front, which can eat into your bottom line and your profits at the end. So we wanted to make sure that this product was going to be completely open. So this product is a 6-month completely open term, so there's no cost to break. As soon as you're done the project or you've stabilized and repositioned the building, you can refinance into a conventional lender without cost, which it saves a ton of money on the back end. Now, we understand that it might take longer than 6 months to be able to finish your project. That's why after the 6 months, if you're in good standing and you've made all your payments and your project is moving forward as requested, then you can move into another 6-month open term, which allows you to have another 6 months. There's no additional fees, there's no broker fee, there's no lender fee. We just want to work with you to ensure that your project is going to be completed on time.
I love that, yeah. So with investors working with a more traditional approach, it sounds like they're going to be hit with a lot of penalties if they try to do exactly what you're describing. So this really allows for that flexibility, which I think is really important from an investor standpoint, to be able to actually move forward and pursue these multifamily buildings.
For sure, yeah. In regards to rates,
Yeah, so the rate is going to depend on the amount of down payment. So the loan to value that we have on this one, max loan to value we're able to get to is 90%. So there's a few things that we got to take a look at. First off, does 90% loan to value on the acquisition make sense for where your values are going to be on the back end? We want to make sure it's a smooth transaction. If you're going to be, if you have to get every single tenant out just to be able to refinance out of that 90%, maybe 90% doesn't make sense. We want to make sure it's going to be a doable transition. And then the down payment and the interest rate are going to scale inversely. So the less down payment you put down, the higher interest rate it's going to be. Now we do have the options to be able to offset that with a collateral piece of property. If you have some equity in a property that's either free and clear or a significant amount, you can put the 10% down. We can blanket your secondary property and get that interest rate back down into the 8 to 9% and keep it a little bit more manageable. Again, when you're putting that 9% or that 90% loan to value on your property, you're going to be sitting in around that 13 to 14% interest rate. So it is a bit higher, but again, we're looking at saving some of the costs up front and being able to essentially just build that into carrying costs instead of having to come up with capital up front. Like Josh mentioned, the flexibility on it is quite great. The other big key is that the fee is involved. So it is a private product, so there is going to be a fee. It's only 3%, whereas most private fees, if you're working with a broker and a lender, you're going to be around 4%. So we shave off 1%. It's built into the mortgage. So again, trying to cut some of the costs that's needed up front. Obviously, when you're repositioning a product and you have renovations, you have cash for keys, you have miscellaneous and just capital reserves. The last thing you want to be doing is coming up with more capital to be putting down towards the fees and the closing costs. So we're able to build that into the product, put that onto the back end. That's paid out either when you sell the mortgage or refinance out. So again, we're really just looking to cut the cost coming out of the investor's pocket up front, allow them to just build that into carrying and make it a little bit more manageable.
Absolutely. And as you mentioned at the beginning, this is more of a repositioning product that allows for somebody to go off market to on market for that refi and really ultimately gain the most from that duration and have the most flexibility. So it has a higher cost of interest rate, but it allows for that flexibility. You're not going to get hit with a bunch of expenses or terms that are ultimately going to potentially cost more in the long run anyway. So this sounds like a great way to really do what you need to with that multifamily and have a lender that really understands what your goals are and what you're trying to accomplish as an investor. So anything else that we should know about this product?
Yeah, so when we underwrite this product, the main and most important aspect of it is, can you do it and is it profitable?
Right.
So two really important things. One, like, are you going to make money doing it? We don't want to give you a job. Like, we want to make sure that your ability to be able to do this is going to allow you to create profit and your exit strategy is sound. So how we do that is we take a look at an as is and an as complete value. So we're going to get a professional appraisal done by somebody that we trust. We're going to take a look at what the current value is at the moment and what is going to be the current value once you position the building and stabilize it with market rents. And that'll allow us to take a look and say, okay, this is the ability, this is the spread on the building at the moment. And we do it through a third party because then both ourselves and our clients can realize that this is truly a viable option. How we do that is we take a look at your renovation budget. So when you come to us, we're going to ask you, what is your plan? Outline your renovations. If you have some sort of budget to deal with the vacancy situation, then show us that budget, show us your outline of per unit cost to being able to renovate the property. And your as complete value is going to be based off of all of this happening. Now, it's not good enough just to say I'm going to do it. You need to show us you have the capacity and ability to do it. So I need to see either cash in a bank account, I need to see a line of credit availability, credit cards, money of some kind to be able to show, like, this is my cost and this is my ability to be able to actually complete the project, because we don't want to be in a situation where you find a property but you don't have the capital to do it. So giving us the comfort knowing that you can actually do the project and follow through with it is really important. Now, another thing to consider is your experience as an investor as well. If you've never done this before and you've never bought a property before, maybe having somebody come on with you who has some experience in doing this would be really important, because our lenders want to feel comfortable knowing that you, again, have the capacity to be able to complete the project effectively. So if you can give us some of your exited projects that you've done, if you've turned over maybe a duplex or a triplex and you've completed some renovations, but that history just allows us to be comfortable understanding that you can do what you're looking to do. And we're going to make another video just outlining how you go about exiting this product, but the exit is also one of the most important aspects of this product. So we take a look at your debt servicing after you've renovated the property. So does your net operating income allow you to be able to have a high enough debt servicing ratio to qualify with an A bank? Because exit strategy, obviously, when we talked about rate, that 8.99 to 12.99% isn't a long-term viable solution. You can't stay in a product like that. So exit strategy is paramount to the success of this product. So all those things are going to create like a holistic view of your project, and if it makes sense and we think you can do it and you have the capacity and ability and the project is viable, then we're happy to help you guys out.
So I'd love to know, guys, what types of buildings are this product really best utilized for, and what kind of ranges or markets are we working in?
Yeah, so with this particular product that we're talking about first, there isn't really a scope on how large the building can be. We're really limited to the loan size. So we're looking at loans of $1.5 million top. So it can be anywhere from 5 to a 25 or 30 unit building, as long as that loan is going to be $1.5 million. That's kind of the scope for this particular product. So we do have a second product that focuses on larger loans and larger purchase values. So we're looking at minimum loan size of about 1.8 to 2 million. And there are some additional advantages with this product. So on the acquisition, we can do 80 to 85% loan to value. They're also going to cover 80 to 85% of the renovation costs as well too. So it's going to be in a rebate type formula where you get the work done, you bring it back to the lender, you have proof from an inspector or from the GC, and it's written off, and they're going to be able to refund you that cost. So it gives you a little bit more value overall, but it is for the larger buildings. They really love the GTA. The interest rate is pretty competitive as well too, 6.5 to about 6.75%. So we are really getting into that more competitive rate. But again, they love the GTA centric type area. They are willing to take a look at other buildings in larger markets, London, Kitchener, Waterloo, Guelph, slightly outside the GTA as well too. But again, for those larger buildings that require a bit more capital, they have a little bit more flexibility, and they're pretty competitive as well too. Love
that. Yeah. So depending on what your goals are, there's actually multiple products that you could utilize, and if it's within that, you said 1.5 is kind of the cap on this first MRP product, and then you've got the secondary product that actually has super competitive rates and sounds like a great fit for an investor as well. So depending on the building and the market that you're looking at, there are multiple options for your buildings. Well guys, thank you so much for breaking this product down. We're actually going to have a part 2 where we fully break down the exit strategy as Josh has just alluded to. So make sure that you stay tuned in and subscribe to the Canadian Real Estate channel so that you don't miss a beat. Well guys, thanks so much for the video. And also, these guys actually have their own YouTube channel. So make sure you hop over to the Findlay Mortgage Team on YouTube and Instagram and all the social media platforms so that you don't miss out on any great mortgage product information from a team that actually specializes in working with investors. So hop over there and give them a little bit of love, and also throw some love into the comment section. We love hearing from you guys, hearing about what projects you're working on, or really what you're trying to accomplish as a real estate investor. So thanks for tuning in today, guys, and we'll see you on the next one. Peace.